Can't wait for higher interest rates? Be careful what you wish for, amigos. Be careful. All right, so check this chart out. This is fantastic. All right. Put your gaze on this chart. Put your gaze on this chart as I brainwash you with my Neil Tyson deGrasse languaging, science, orbits, cosmos. Shiller Cape going up and down. Treasury yield going left to right. I can't remember the XY. I just can't remember. All right, so the Cape, the Shiller Cape is a cyclically adjusted PE ratios, price to earnings ratios. All right. You can see we're at the highest essentially we've ever been in July. All right. And the 10-year Treasury yield is basically what I consider your risk-free yield, if that makes sense, because 10-year Treasury gives you more than a savings account, and on top that's a government bond, which is guaranteed. All right, so in this case, you can see the price to earnings ratio is significantly through the roof, relatively speaking, when the 10-year yields are way low. I hope 10-year yields start going up. What happens to PE ratios? It starts going down. In fact, as you can see, the interesting thing is between 2, 3, and 4%, the 10-year yields, the PE ratio is below the trend line. Interesting. So at between 1, 2, and basically 3, it's about half-half. Certainly between 1 and 2, the trend line is significantly lower than where we are for price to earnings ratios. It's very interesting here. And this, I'm telling you, I'll wrap this up in a nice red bow for you to understand here in just a second. But you'll see right here that when we start going up the graph, or up the rate ladder, if you will, the price to earnings ratios relative to the trend line starts dropping significantly. In fact, at 3%, look at that, we're way down here. What's that, 12, 13, 14? And the interesting thing is once you get above 4, the PE ratios are significantly higher than the trend line. That's interesting. I think I know a reason for that. But anyway, so what's happening here is that people are saying we have significant price to earnings ratios, and one of the reasons for that is because we have low interest rates. If they raise the interest rates because you want more yield, inherently there's only one thing that's going to happen. Well, two things are going to happen. We're going to keep the PE ratios as highly valued as before, hard to believe, or the PE ratios will go down. So let me draw you something about price to earnings ratios, because a lot of people don't get this. And this is price to earnings ratios is literally the #1 valuation tool that you should use. It says how much for $1 of earnings, how much are you paying? All right, so right now we got a PE ratio of 38. That means for $1 of earnings, and that's the denominator, $1 of earnings, we're paying $38 in price. All right, so for $1 of earnings, we're paying 38 bucks. That gives us a PE ratio of 38. Pretty simple stuff right there. All right, so what happens? Let's go back to the chart. All right. So if interest rates start going up, all right, and the PE goes down, which is what we would suggest, what causes the price to earnings ratio to go down? All right, so if we have a 38 PE right now, and let's just say the earnings goes up to 2. All right, so we're going to scratch the $1 denominator, and we're going to say earnings go up by 2 to 2. So that's a 100% increase in earnings. So now the denominator is 2. If the price stays at 38, our PE ratio is what? 19. So to get back to this, we could say the reason the PE goes down is because the denominator went up, i.e., we're up here now. The reason it starts going down the trend line is because the bottom number of that equation went up in terms of the earnings. The earnings go up to make the prices relative to the earnings lower. Again, going back to the 19 PE that we have. Very hard to imagine that being queso. And the reason for that is because as interest rates go up, the cost for companies to borrow goes up. The cost of their accounts payable go up. Just everything goes up from the corporation line. So it's hard to imagine that as interest rates go up, the reason the PE goes down is because the earnings go up. No one's really going to make that argument at all. So what actually happens, as interest rates go up, you can even make a case the earnings goes down. In that case, you say, well, if earnings go down from 1 to 0.05, and we still have a, let me write this better. So if earnings go down from 1 to 0.5, I guess, and we still have a 38 PE, because interest rates go up, the cost to service our debt has gone up, the cost to borrow has gone up, everything goes up as interest rates go up. The cost-wise for leveraged companies, which many are, our earnings are still 38. Now our PE ratio is what, that 76? So now we're paying $76 for $1 of earnings, which is more realistic in this scenario. Because the cost of, basically cost of goods sold, COGS is what's called, goes up as interest rates go up. That means the earnings is going down. So why would the PE ratios go down? It seems counterintuitive. Why? Why do you think? There's an answer to this. This is a very, very simple answer for this, but think about it. The cost of goods goes up as interest rates go up. Why? Because just simply, you're paying more for debt. No other way around that. Simple, simple, simple. Well, why then would the PE ratios go down? That doesn't make sense. Because I'm sitting there thinking, okay, so the PE ratio should be going up. We should be going, the trend line should be like this instead of like that. The trend line should be going up as the interest rates go higher. But it's not. Why? Because everyone forgets the other part of the PE ratio is the P. Everyone forgets is this right here that really drives the PE ratio, the price. The price is your willingness to pay for a stock for $1 earnings. That we can say is speculative, but is not, we can even say it's not rational, it doesn't matter. The point being is the price more than the earnings is what determines the PE ratio. And what happens here is, just going back, as the interest rates increase, the price goes down because people have a second, it's in economics called the substitution effect. They can say, look, I don't want to pay for a $38 stock anymore for $1 of earnings when I can get 3% on bonds guaranteed as a risk-free asset. As the risk-free asset price goes, or the yield goes up, it makes the stock market look less attractive. They're alternative investments. And that doesn't mean timber and all that crap that, what's his name, Swenson over at Harvard or Yale, I can't remember. I think it was Yale, actually. I can't remember. Maybe it was Harvard, but did. Alternative investments just means I don't need to be sitting in a 38 PE ratio. The reason I'm sitting there is I'm only getting 1% yield on my 10-year treasury. Screw that. Now the 10-year treasury is yielding 3. I'm not going to pay $38 for $1 of earnings. I'm going to pay a third of that, essentially, is what's happening here. So as the interest rates go up, people say, I'm not going to pay these high prices. I'm going to pay a lower price because I have an alternative investment. People don't get this, man. They're like, oh, yeah, the prices will stay the same. No, they won't. Which is the basis of the don't fight the Fed theory. As Fed's raising interest rates, the stocks go down because there's a risk-free asset that's improving its value. You say, oh, yeah, I think I am going to buy that. I'll sell my stocks, take the gains, take the gains, take the gains, and put them over here in the bond market for safety. It's just rule number. So now we got a PE ratio, and on top of this, so check this out. So now what was 38 to 1 as a PE ratio of 38 becomes, I don't know, 20 to 1. So now we have a PE ratio of 20, not because the earnings have changed, but because the price has changed. People don't want to pay 38 for $1 stock. They'll pay 20. So what happens to your portfolio? Well, you are right there down $18 a share. I'm telling you, man, you're down $18 a share. And if we go back to here, historically, the CAPE's, what I think the historical PE ratio is about 15.5. I think the historical CAPE's about 22 if memory serves. So this is when we have a 5% Treasury. A couple things going on there. People are probably not raising rates anymore on bond. I mean, hard to imagine the 10-year Treasury going much beyond 5%. So I imagine people are saying, look, I can't see them raising the Treasury rate, so I'm just going to lock in. But because this is probably the extent of where it's at, I'm going to buy some stocks anyway. Because they're not going to raise anymore. I would think that would be the assumption. I don't know that to be. I don't know if you can make a case that says, well, when rates get 5%. The bonds lose their appeal and the stocks get more appealing. I don't think that can be. I think that's a correlation without a causation, frankly. But I do think the reason the PE is going through the roof, through the floor here, the trend line floor, is because as rates are going up, people say, well, if rates are from 1 to 2, they're going to go from 2 to 3, 3 to 4, and then basically consolidate at 4.5. I'm pretty comfortable with that. But remember, don't fight the Fed. So as rates are going up, they're more likely to continue to go up to a certain point. Again, we'll say 4.5 to 5%. That's what I think is happening here. And I think it's 100% true. If you look at 94, 99, when the Feds were raising, same kind of thing. They didn't just raise up 50 basis points. They raised and they raised and they raised. And I think that's what's happening here. People saying, well, we're in a raising environment. I'm going to get out of stocks, sell them. So I no longer have a 38 to 1 PE ratio. I have a 20 to 1. And park some money on the side, waiting for the Fed to finish up their raising. And then I'll jump back in stocks when the price has gone down. That's what I think is happening here. Anyway, pretty good article. I'll put a link in the show notes. But do not, if you're sitting there heavily in stocks and you think they got to raise the rates, you better not be thinking that. Now, the converse of that, if you're sitting there heavy in cash and short-term bonds thinking they're going to raise the rates, you've been wrong, dudes. I don't think the Fed has any incentive to raise rates whatsoever. I don't. I think you can just look and say, why would they raise rates? They don't need to, man. Why would they give themselves more debt to pay? The Fed raises rates, what does that do? It makes the line item of the budget, the cost of the budget for the federal government, which is heavy, heavy, heavy debt burdened, it makes it even more expensive. And they don't need to do that. People are buying federal government bonds left and right, as is right now. So I'm not expecting rate time change anytime soon. All right, love your thoughts. We'll see you.